This session, titled The 2008 Global Financial Crisis, is really a culmination of a lot of the theories we have learned in this course over the last few weeks. There are three components that we have looked at earlier which I want you to recall. The first one is mortgage-backed securities. Remember, mortgage-backed securitization is the process that transforms a pool of home mortgages issued by a financial institution into securities that can be traded in the financial markets. Second, credit default swaps, or CDS, which are over-the-counter bilateral contracts that transfers the credit risk associated with a financial asset like a home mortgage from one counterparty to another without transferring the ownership of the underlying asset. And the third, collateralized debt obligations, CDOs, which is a structured financial product that converts a portfolio of loans or bonds or mortgage-backed securities into tranches that are sold to investors in the financial market. Now, these three entities combined, MBS, mortgage-backed securities, CDS, credit default swaps, and CDOs, collateralized debt obligations, turned out to be a lethal combination that resulted in the 2008 global financial crisis. In the next few minutes, I will construct for you how this crisis evolved, what caused it, what are the consequences, and why even to this day we are suffering from the aftermath of that crisis that happened almost 8 years ago. So let's look at a very innocent scenario which is prevalent in most countries around the world. You have banks that would give home loans to customers. In some countries they are called home mortgages. Let's take a very specific example. Let's say there are 1,000 customers who came to the bank and took a home loan each at, shall we say, 1 million CCU on an average. So this bank has now a portfolio of 1 billion CCU worth of home loans. Now remember, it's running a serious risk if it keeps it in its own books, because the home loans are usually of a very long duration and will live in the balance sheet for almost 10 to 15 to 20 years, whereas the deposit support on the liability side would be for a much shorter period. Therefore, there is a motivation for this bank to package these 1 billion CCU worth of home loans and sell it in the financial market. Now this, as you would recall, is mortgage-backed securities. So this 1 billion worth of home loans are now split into securities of, shall we say, 10 million CCU each. That means 100 securities of 10 million CCU, and that is sold in the financial market. There will be several buyers for it in the financial market. So far so good. And what happens is the buyers in the financial market would pay the bank at a discounted price for the future cash flows that they've inherited on these home loans. Now that's a perfectly valid system to exist in any financial market. But where did it go wrong? It went wrong because banks became very flagrant and very adventurous in the number of housing loans that they started to give. Because remember, now they have a perverse incentive to actually give as many housing loans as they want, because they would be able to flog it as mortgage-backed securities in the financial market. So banks just started to lend willy-nilly, and they started to lend to customers who would otherwise not even be eligible for a loan. This, in hindsight, came to be known as subprime mortgages. Subprime mortgages. That means home loans given to people who are not worthy of getting a loan, who are not credit worthy to get a loan. Now the banks had no problems issuing that because all of it was being sold to someone else. Now this started to build thick and fast. What was the ramification from this? Now remember, the holders of this securitization paper have never seen these borrowers. They have not done a credit evaluation of these borrowers. So they got very worried, because what if the borrowers, that means the people who took the home mortgage, failed to repay the home mortgage? So they went to the banks and said, can you do something about it? In case the borrowers don't repay, we cannot take the loss. So the banks came up with a very unique solution to this problem, which has come to be known in the world of banking as CDS, credit default swap. Now a credit default swap, as you will recall from an earlier lesson, is simply an insurance policy. The bank that is issued the securitization paper would pay a premium to the company that writes the CDS, the assumption being, should the original borrower fail to repay his obligations on the loan, the CDS writer would actually pay the bank, who would in turn pay the holders of that securitization paper in the financial market. Now this worked perfectly, because as far as the holders of the securitization paper were concerned, if the borrower didn't pay, the writer of the CDS would pay. And the banks were quite happy with this arrangement, because all they had to pay was the premium to the CDS writer, which was less than 5% of the value of the portfolio of home loans. Now this carried on unabated. As a result, the financial markets started to bulge, and there was another very clever product that was introduced, which was called the collateralized debt obligations. In other words, in the financial market, entities who are buying the securitization paper had varying risk appetites. For example, pension funds were low risk appetite, whereas there were high net worth individuals who were willing to take a very high risk. So the collateralized debt obligation manager, the CDO manager, created three tranches: the lowest risk tranche, the middle risk tranche, and the highest risk tranche. He took the securitization paper and sold it in three tranches to these three different entities. Now this made the sale of mortgage-backed securities through the CDOs even larger. So you got a very exciting situation in the financial market, where the risk was being borne by the CDS writers, and depending on the risk appetite, various entities in the financial markets could buy different tranches in the CDOs. So the market just started to bulge, and all kinds of people who didn't deserve a loan could go up to a bank and get a loan. Now this party was getting on absolutely fine until, remember, the mortgage-backed securities paper is traded like bonds in the financial markets. Now as long as the interest rates were falling, and particularly in the American system, interest rates fell quarter after quarter after quarter because of macroeconomic decisions by the Federal Reserve. Now please recall your lessons in bond pricing, and mortgage-backed securities are working on the same principle as bonds. When interest rates fall, the value of the mortgage-backed securities paper would rise. So let us say you bought this mortgage-backed securities paper for 100 CCU face value. A quarter later, when interest rates fell, the price of that paper would go up to 101. And what did you do? You sold it at 101 and made a profit of 1 CCU in just one quarter. So if you annualize that, you're getting a return of about 4% or more. Now the person who bought it from you at 101 CCU would hold it for another quarter, and he knew reasonably predictably that interest rates would fall again. So the price of the mortgage-backed securities would go up to 102. So in one quarter, he bought it at 101, sold it at 102, he's also booked a profit. So everybody in the chain was making money and making merry. When did this party stop? When there was a change of leadership in the Federal Reserve. A new chairperson came along in the name of Ben Bernanke, and he said, we cannot reduce interest rates any further. Interest rates have to go up. So the last person in the chain who probably bought the securitization paper at 104 CCU and believed it would go up to 105 CCU and he could sell it and make a profit, suddenly found himself sitting with a paper that was losing in value because interest rates have taken a U-turn and they started to rise. He was sitting on a mark-to-market loss. Now, to add fuel to the fire, because of the excessive lending on home mortgages by banks, there were far too many homes that had come up. And as a result, there was excess supply of homes in the system. What did this do? The underlying value of the home started to fall because there is excess supply, lower demand, principles of economics, home prices started to fall. Now, this also had an impact on the mortgage-backed securities paper because when the real asset that is backing the mortgage-backed securities loses value, that means the home loses value, the mortgage-backed securities, which is the financial asset riding on that real asset called the home, also loses value. So there was what people call a double whammy. The price of the mortgage-backed securities paper, which was being held by the CDOs and several other entities in the financial market, were sitting on a double loss. One, because interest rates have risen, and the second, because home prices had fallen. Now, there was a third angle to this. Because of the easy availability of money, several individuals were approached by banks and were given loans freely to buy a second home. So let us say I have one home and I need to protect it at any cost because I need a home to live in. Now the bank approaches me and says, hey, take another loan, rent it out to somebody else, and from the rental income you can pay your mortgage payments monthly. That is a very attractive proposition for me, so I went and bought the second home. And when there was an excess supply of homes, there were not enough people to rent those homes, which means I did not have the cash flow to pay the mortgage payments against my second home mortgage. So I went up to the bank and said, take this home back. This is my second home. I'm not able to pay the mortgage, so take it. Now what did this do? The original issuers of the home mortgages had a lot of homes which they had to take back, and this resulted in a further crash in the price of the homes. So there were three reasons. One, interest rates went up, so the mortgage-backed securities values went down. Two, there was excess supply of homes, so the underlying asset dropped in value, and therefore the mortgage-backed securities paper lost value. And three, because of homes that were being returned by the mortgage holders because they're not able to pay the monthly mortgage, there was an excess holding of homes by the banks, which further resulted in the price of homes falling, which had a further impact on the mortgage-backed securities. Now this caused a huge mayhem in the market. It caused a mayhem because a mortgage-backed security whose value was, shall we say, 100 CCU face value, was, because of this triple whammy, selling at 60 to 70 CCUs. That means there is a mark-to-market loss of 30%. Now, this was not affordable by several players in the financial markets, and they all started to unwind their positions from the market. In other words, I'm holding a paper for 100 CCU. It is worth only 70 today. I'd rather sell it at whatever the price, cut my losses and get out. I didn't mind losing 30 CCU on 100 CCU face value, but I'd rather not hold it any longer. Now this further snowballed in the reduction in the value of the assets in the financial markets. Now remember, the big players in the mortgage-backed securities market, the CDO market and the CDS market, were among the largest investment banks in the United States. Big names: Lehman Brothers, Goldman Sachs, Merrill Lynch, Morgan Stanley, AIG, who were the biggest writers of credit default swaps. Remember, they're an insurance company, so they were very happy to write credit default swaps. Now, when the mortgages were failing to repay, there was a huge call on AIG, the biggest writers of credit default swaps, to say, please pay up because the borrowers are not repaying their obligations. So AIG went bankrupt because of the CDS they had issued. The first casualty was AIG, then were institutions like Bear Stearns, and you'd have all known by now, Lehman Brothers went bankrupt and disappeared from the face of this earth because of this crisis. Now, if you look back, and this is wisdom in hindsight, this crisis happened because of avarice. It just became very easy to issue home mortgages, and everybody wanted a better return on his financial assets, and here was a paper that was giving them that opportunity called the mortgage-backed securities, and when interest rates were predictably falling, everybody was making money. But when it took a U-turn, the party stopped and everyone got into trouble. So from about the end of 2007 through to the end of 2008, the markets had gone into a tizzy. The total loss exceeded $700 billion US. Now, there was no chance except for the government of the United States through the Central Bank of the United States, the Federal Reserve, had to actually bail out these banks. In other words, $700 billion of taxpayers' money had to be pumped into the financial system in order that this situation, this crisis, could be averted. Even to this day, countries around the world haven't gotten over that hit that they had to take in 2008. Now remember, the purchase of these mortgage-backed securities and investment in these CDOs was not limited just to banks in the United States. There were banks from all over the world, particularly from Europe, who were also participating in these markets, because when the going was good, the returns was phenomenal. When the going got bad, all of them got terribly hit. And the world is still recovering from the 2008 crisis. There were several regulatory changes that have been brought about as a result of this, including the Basel III guidelines, which makes life very difficult. However, this is my personal observation. Many others might not agree with what I'm saying. A guideline like the Basel III punishes only one part of the system. Basel III applies only to people here, which is the banks, not the financial markets. Even to this day, they are not governed by any regulations. Players in the financial markets are intrinsically unregulated entities, whereas banks, through Basel II and Basel III, are over-regulated entities. So if you look at it philosophically, there is a regulatory arbitrage that entities in the financial markets can play, because the capital adequacy requirements are borne by the banks, not by the players in the financial markets, which is why several financial economists, and that includes me in that school, believe that one more crisis of a similar nature is not far away, because we overcame the last crisis, but there's another one in the offing, and the same causes and the same consequences could recur. Difficult to predict when. Could be anywhere 2025, 2030. And we'll probably have a new set of regulations which is going to punish the regulated banks, and the financial markets would have a free-for-all. Now, my humble proposal is anybody playing in the financial system, may he in the banking sector or be he in the financial market space, must be subject to the same degree of capital adequacy and regulation. That's the only way to prevent this crisis from happening again. As long as there exists a regulatory arbitrage in the financial system, this crisis is bound to happen again. And should it happen, do remember, in this MOOC that you're doing, we predicted it was going to happen again. Bye for now.